In Chapter 12, we're going to discuss revenue recognition and reporting results of operations. A company's pattern of sales and earnings are important factors in evaluating its success. If you look at Costco, they've really focused on high sales volume and rapid inventory turnover, and they've done this by volume purchasing, efficient distribution, and reduced handling of merchandise. And they've been very successful at it. And this shows up by operating at lower gross margins than most other retailers because they've been able to do that. And it's shown up in their success with sales increasing rapidly as well as earnings increasing substantially over the last few years. And these represent, arguably the most important figures in their financial statements to see how well they're performing. When revenue is included in a company's income statement, we argue that it is recognized, and recognized suggests that it should be recorded. So recorded and recognized should be viewed as synonymous. And so revenue recognition says when this revenue should be recognized, when it should be included in the financial statements. In general, principle is recognized when it's earned. And so that means the company receiving the revenue has done everything required in its agreement with a customer related to revenue. And this suggests that the company has done everything to earn the revenue. And so they've completed everything they agreed to do, and the revenue can be reasonably estimated. And we also apply the matching principle to match the revenues with the expenses required to generate or earn that revenue. It is a significant impact on the financial statements. Many items such as cost of goods sold, wages, utilities, taxes depend on how much revenue was recognized. So recognizing revenue is of critical importance. So we need to make sure we understand it. Now, thinking of revenue as a contract is an agreement between two or more parties that has enforceable rights and obligations. The earning and subsequent recognition of revenue is the direct result of a contract between a seller, like Costco, and a buyer, like me. So several aspects of sales transactions may complicate the revenue recognition process. Well, why is that? Routine transactions, no problem. The financial implications of the uncertainties can be estimated. I go and buy a TV. Hey, no reason to delay the recognition of that revenue. But we often need to know and understand the performance obligations. So to determine when and how much of the revenue should be recognized, we need to recognize the performance obligations. So we're going to define this performance obligation as a promise a seller makes to transfer goods and or services to a customer. The timing of revenue recognition is directly tied to completion of the various performance obligations in the contract. And as performance obligations are completed, the seller recognizes that revenue. And again, when I say recognizes, think book a transaction, book a journal entry. Some transactions have multiple performance obligations. And so it is often important to separate the revenue into 2 or 3 or more components or elements. For example, assume an automobile dealer sells a vehicle and offers 2 additional services. One is an extended warranty for 2 years beyond the manufacturer's 3-year warranty. The second is an optional agreement to service the vehicle for the first 3 years, not the first 2. The automobile dealer has 3 performance obligations. It's got to deliver the vehicle, complete the warranty work required by the extended warranty agreement, right? And to service the vehicle for the designated period. The automobile dealer allocates the total amount among these of the revenue among these 3 obligations and as they are completed. For example, assume the total transaction is $35,000 and the extended warranty is estimated at 5% of the total price, less the amount of service agreement, which is estimated to be $400 per year. So we're committed $400 a year for 3 years. That's that $1,200. The vehicle delivery is $32,110 and the extended warranty is $1,690. So as these are completed, we can go and recognize the revenue. So vehicle delivery, boom, we can immediately recognize $32,110. and recognize these others as the performance obligation is completed. So because the importance of income reporting and making assessments about the future events and transactions other than normal recurring revenues and expenses require careful attention in the preparation and interpretation of an income statement. Okay, so the results of items not likely to repeat are separate. Okay, and so they're either non-recurring items or unusual and or infrequent, as well as discontinued operations. Okay, so we sold a portion of our business. We sold a line of business. We've sold a factory. Okay, those are going to be included separately. So let's give an example of an irregular item. Farmer Corporation operates both a small chain of retail stores and 2 motels. During the current year, the company sells both motels to a national hotel chain. In addition, Farmer reports one unusual and frequent item, a loss on the settlement of a lawsuit. So that's not going to be happening in the future, expected. All right. So how do we account for these? Okay. Well, first we have some discontinued operations here. First of all, we have an operating loss on the motels as discontinued. And we also have a gain on the sale of motels of $455,000. So you can see that included there. You can see separately the loss on settlement of lawsuit included as a cost and expense. Okay, so let's read a little bit further here. Discontinued operation. When management enters into a formal plan to sell or discontinue a segment, the results of that segment's operations are shown separately. Okay, so it may not have been sold yet, but there is a formal plan to sell or discontinue. Excluding the part of the business that will no longer affect the company's operations in the future enables users of the financial statements to better evaluate the performance obligations. And so we're going to see that the items we're going to show is the income or loss from operating the segment prior to its disposal and the gain or loss on disposal of the segment. So 2 components here. And the income tax related to discontinued operations are shown separately. And so we're going to show these 2 items net of any tax impact. And so those taxes are going to be computed separately. Okay, so let's go back and peek at these financial statements. You can see this is net of any income tax benefit, net of any income tax benefit. And we're going to notice this income tax expense, this portion only applies to the operating or continuing operations. So you can see how that shows up. The next thing we want to talk about is unusual and or infrequent gains and losses. So unusual and or infrequent gains and losses don't recur often, do not occur in predictable patterns, are sometimes referred to as non-recurring items. So examples include losses due to labor strikes, gains or losses on the sale of plant assets, we're not expected to do that, losses from storms, natural disaster losses due to lawsuits. Okay, so unusual and or frequent items are not presented on a net of tax basis. I often think of this as above the line or below the line. And so as you see this, because we're reporting this here, this loss on settlement of lawsuit as an unusual or other gain and loss, it's going to be shown before the line. Okay, and so since it's before the income tax line, it's going to be shown gross. And then we're going to take out the taxes on all of this portion above the line there. So you can kind of see what that looks like there. Okay, so not presented net of tax, and any income tax effect is combined with income tax on normal recurring revenue and expense items. All right, how about a restructuring charge? Restructuring charges are losses such as write-downs on plant assets not worth as much as we thought, sale of plant assets, severance pay, relocation of operations, and or employees. Okay, so such charges are presented on the company's income statement. Okay, but if the restructuring involves discontinuing a segment, then that's going to be part of discontinued operations. But if it's just restructuring, and all these don't suggest discontinuation, so not showed as discontinued operations, but if it does, we need to show that appropriately. All right, so let's see what this looks like. One of the most important determinants of company stock price is expected future earnings. Okay. Assume that you are considering investing in Worsham Corporation and are evaluating the company's profitability, net income of the corporation, includes loss on discontinued segment and a gain on sale of land to the city of Phoenix. Assuming the gain on the sale is based on total received and does not include income taxes, which are expected to be 30%, we need to adjust net income to develop a number that represents a starting point for predicting future net income. So this gain on sale is not expected to continue to occur. And so we need to make sure to take out the net impact because the financial statements don't already do this. But the loss on discontinued segment is already net of tax. So you kind of see the difference there and your job as an investor. Now, next we compute earnings per share, and usually it's pretty easy to compute, and we just take the earnings, the net income, and divide by number of shares outstanding. Well, what happens is sometimes there's events during the year, and so we issued more stock, we had a stock split, something happens, stock dividend, there's various events. And so we're going to get a weighted average of that over time. We're going to show an example of that. But earnings per share only applies to common stock, not to preferred shareholders, because they have no rights on the earnings beyond their preferred stock dividends. So here's the example. Assume a company had 80,000 shares of common stock during the first 9 months of the year. The company then sold 60,000 additional shares, so that 140,000 were for 3 months of the year. And so we're going to take the 80,000 for the 9/12 of the year. We're going to take 140,000 for 3/12 of the year, and we're going to have weighted average shares outstanding of 95,000. So if we had earnings of 250,000, 95,000 shares, we'd have $2.63. Okay. So that helps us with our computation of weighted average shares. All right, how about preferred dividends and earnings per share? When a company has preferred stock outstanding, the preferred stockholders participate in net income only to the extent of the preferred stock's stated dividend. To determine the earnings applicable to the common stock, we need to find the net income that applies to the common shareholders. And so we need to subtract out the annual dividend on cumulative preferred stock first to then get the amount that applies to the common shareholders. So let's provide an example of this. Assume that Perry Corporation has 200,000 shares of common stock and 12,000 shares of 6% cumulative preferred stock. Net income is $5.95. All right, we know we do our computation only on common shares, so we're going to take the $5.95, subtract out the dividends for that year, and so the earnings applicable to common stock is 523,000 divided by 200,000 shares outstanding to get $2.62. So we can see what that looks like. All right. The earnings per share is required to be presented in their income statements. If an income statement includes discontinued operations, then we're going to show that for both income from continuing operations as well as net income. Okay, so we're going to show both of those figures. Okay, so we can see how that looks. So here for Perry Corporation, we have some discontinued operations. That means we need to show earnings per share twice. So earnings from continuing operations. And so we're going to take the 805,000, subtract the 72,000 preferred dividends to get $3.67. And we're also going to take the 595, subtract 72,000, this is net income, divided by 200,000 shares to get the 262. And so we can see what that looks like there. So it's required to show both, so we do so. We're also going to show the amount of loss from discontinued operations, but required to show both of these components. All right, so valuation multiples such as PE ratios, price earnings ratios, are often used to evaluate a firm's value. The use of price multiples to compare companies from different countries is challenging for many reasons. It's because there's differences in accounting principles. So we may not choose to use PE ratios to compare those from Japan to the United States because they simply have different accounting principles. So let's say you're working as a financial analyst and you're looking at these numbers and saying, okay, what should I be using? Well, we have discontinued operations, meaning that's not going to continue any further. So we'd be more likely to use income from continuing operations as what we would expect to continue in the future rather than net income, because that reflects the discontinued portion as well. And so that's what the financial statements are trying to help us provide, is a look at what is expected, what could be a realistic expectation for future profitability. We can see it's gone from $1.75 to $3.02 and see that that has a dramatic impact. Investors buy stock with the expectation of getting their original investment back, as well as earning a reasonable return. And it's typically the return on a stock investment is both appreciation in stock, like the stock price is going to go up, or the value of the stock, as well as cash dividends. So the requirement of cash dividends is there needs to be available funds. And at least theoretically, the maximum dividends that can be paid out without liquidating the company would be its retained earnings. We also need to have adequate cash on hand. We need to have an action by the board of directors that says we need to declare a dividend, so we see those. We can also see 4 significant dates. When was it declared? When did the board of directors say we need to do we need to pay cash dividends? Okay. And so on that date, we're going to book it. We're going to record a journal entry. We also have an ex-dividend date. The ex-dividend date is significant because a person who buys the stock before the ex-dividend date gets the dividend. If it's sold after the ex-dividend date, they will not receive the dividend. So it's going to be shareholders, investors of record as of that date. The third date is the date of record. The date of record follows the date of declaration, usually by 2 to 3 weeks, and is stated in the dividend declaration. To be eligible to receive the dividend, a person must be listed in the corporation's record as the owner of the stock as of the date of record. Okay. So first of all, do we have rights to it? Does it include the stock? Does it not include the dividend? Not include the dividend? And the date of record, which says, do I own it as of a certain date? And then the date of payment is finally made. On the date of declaration, we're going to make a journal entry. In this case, 125,000 shares, $1 per share. We're going to record that on December 15th. On the ex-dividend date and the date of record, no journal entry is made. But finally, on the date of payment, when it is actually paid, we're going to debit dividends payable to reflect that the liability is now gone, and we're going to pay out cash of $125,000. So we can see that there. As an example, all right, on June 1st, 2028, a corporation's board of directors declared a dividend for 2,500 shares of its $100 par value, 8% preferred stock. Okay. Dividend will be paid on July 15th. Which of the following will be included in the July 15th entry? So we have a bunch of possibilities here, right? Okay, the date of declaration is June 1st, but paid on July 15th. So which one will it be? And as we look, we see that we're going to be debiting dividends payable because we're finally paying it off for $20,000. And we'd actually be crediting cash for $20,000 on that day rather than a debit. So you can kind of see what those look like. Now, liquidating dividend occurs when a corporation pays a dividend that exceeds the balance in its retained earnings. Liquidating dividends usually paid only when the corporation is going out of existence and represents a permanent reduction in the size of the operations. Stockholders may assume that a dividend represents a distribution of profits unless they are otherwise notified. There might also be a stock dividend. A stock dividend is a term used to describe distribution of additional shares of stock. Dividend has been declared is satisfied by issuing additional shares of stock instead of being paid in cash. Most stock dividends consist of additional shares of common stock distributed to holders of common stock. And so that's how they would look. So comparing the differences, cash dividends represents the distribution of cash and reduces assets and stockholders' equity, but stock dividends doesn't do either. There is no change to the stockholders' equity section. There's no distribution of assets. you do receive additional shares in a stock dividend, but the ownership percentage is no larger, no different than it was before. Assume that a corporation has 2,000 shares of common stock and is owned equally by James Davis. Each own 1,000 shares of stock, and they receive a stock dividend of 10%, and 100 shares goes to each of these two shareholders. Whereas they owned 50% of the business before, they own 50% of it after, and it didn't affect assets, liabilities. They don't have more cash, and the total stockholders' equity is exactly the same. So in accounting for relatively small stock dividends, the market value of the new shares is transferred from the retained earnings account to the paid-in capital account. So the overall retained earnings, the overall amount of the stockholders' equity hasn't changed. It's still the same. But what we're doing is we're transferring some from retained earnings to the paid-in capital amount by the amount of the market value. And we'll call this capitalizing retained earnings. So as an example here, Aspen Corporation has outstanding 100,000 shares of $5 par value common stock with a market value of $25 per share. On this date, the company declares a 5% stock dividend distributed on July 15th to stockholders of record on June 20th. All right, so here is the entry. Okay, so first let's notice it's $25 per share. Okay, and we are distributing it for 5,000 shares. So 5,000 times $25 is $125,000. Since its par value is $5, that's going to show up there. That's 5,000 times 5. And the additional amount, 5,000 times 20, the amount left is going to be the amount of additional paid-in capital due to stock dividends. So we can see what that looked like. In some essence, we are capitalizing retained earnings. Why stock dividends? Management often finds stock dividends appealing. Stockholders favor stock dividends because they receive more shares, and for small stock dividends, it didn't change the share price proportionally. So also the dividend is not subject to income taxes, which people like. You can decide when to sell and when to pay taxes. An investor who purchased 100 shares of Home Depot in 1985 would have paid $1,700. 15 years later, that stock would be worth $273,000. So does that mean that each share increased in value from 17 to 27.30? No, in fact, this probably couldn't happen. Investors like to buy stock in shares in lots of 100 shares. Okay, so probably didn't happen to buy just one, but per share makes sense. But could you afford 27.30 times 100 shares? That'd be $273,000. And so that's one reason that stock splits, stock dividends occur. Home Depot's board of directors wanted to attract more small investors. So what did they do? They had some stock splits and stock dividends. And there's a reason that the market value changed, but now it's much more affordable. Instead of, what do we decide, $273,000 per share, or $27.30 per share, or $273,000 for 100 shares, it's going to be much more affordable. So you can see what that looks like. Okay, so we can see a few distinctions between stock splits and stock dividends. We want to make sure that we understand that difference. In addition to a balance sheet, an income statement, and a statement of cash flows, some companies present a statement of retained earnings. So here's the retained earnings at the beginning of the year, increased by net income, decreased by cash dividends and by a stock dividend to give us our final retained earnings. Sometimes retained earnings are restricted. Let's say you're a creditor and you don't want all of the retained earnings to go to the shareholders. So you might restrict it for a certain reason. And if it is restricted, we're going to disclose those restrictions and the reasons why in the footnotes. We also have something called comprehensive income. You can think of comprehensive income as having two components, net income and other comprehensive income. And those two components make up comprehensive income. These can be displayed to users two ways. One is as a second income statement, of which a component is net income, where we just take net income and add other comprehensive income. Or the other one is just to include it as a single income statement that includes those components. We also have a statement of stockholders' equity, and that reflects the beginning balance plus any adjustments that are made in there to stockholders' equity. So, for example, net income would be one. Dividends would be some. You can see the different categories, be it preferred, common, additional paid in capital, or retained earnings. So you can see those components there.